Ladies and gentlemen, welcome to the FinTech Frenzy. Nope, never mind. Not the FinTech Frenzy, the earnings call. It's early for me. So it's Shift4, ladies and gentlemen, and we are going to be breaking down their earnings, which was a miss on revenue and a large beat on earnings. So that's what we're going to get. That's what we're going to do. And let's take a look. All right. So I don't know if we should get into the numbers or the letter. I have not read the letter yet, so it's super important that I end up doing so. But overall, payment volume has continued to skyrocket. Gross profit growing. Gross revenue less network fees is a very interesting line here. So that's one that we're going to talk about a lot. But let's just go through, because I know a lot of you guys follow me for SoFi content, for Robinhood, Nubank, whatever. And Shift4 is a very new name. So they're a payments company, point of sale, restaurants, stadiums, all that sort of good stuff. So end-to-end payment volume, very interestingly, has been keeping up a 75% compounded annual growth rate, or a 10x since Q2 of 2020. All right. Gross profit and gross revenue less network fees is also quite interesting. Gross profit, 62% compounded annual growth rate. Gross revenue less network fees, a 48% compounded annual growth rate. And you'll see in their guidance, that's actually expected to probably be the most exciting line here. I guess they're making some pretty good changes. But anyway, net income came in once again positive, 54.5 million, and that's not on an adjusted basis. I think it's let me check right here on my slide. It's 89.1 million on an adjusted basis. For a lot of really fast growing companies, maybe, stock-based compensation would be a problem or something like this, but that's actually not the case for Shift4. They actually have extremely low stock-based compensation. And any amount that they were giving away, they're actually buying back that and more through buybacks. And that's no different this quarter. They bought back $15.4 million, 15.9, 15.4. Let me just double check. They bought back $15.9 million worth of shares back this quarter. All right. These are some of the companies that they service, but the earnings call is in 10 minutes. I want to get to this shareholder letter because it's extremely important to me. This is from Jared Isaacman, the CEO. This was another busy quarter. I'm reasonably pleased with our results that were largely in line with expectations. We closed on 2 acquisitions, expanded into new countries in support of our strategic customer, and won thousands of SkyTab locations. 1,000s? Holy crap. Stadiums and hotels. Like previous quarters, the enterprise wins we are highlighting this quarter are simply incredible. The hospitality team smashed it with wins like Nobu, Whistler, Blackcomb, and dozens of other signature properties. Similarly, we continue to deliver the W's in sports, deliver the W's in sports and entertainment with Colts, Miami Heat, the Bears, and many more. Let's see here. I want to read this a little bit faster. We continue to win share and accelerating across many verticals. In fact, hotels and resorts now represent approximately 33% of the volume that we process. The strength and diversification has been a key factor in the 11 quarters of guidance raises. That's a strong line, including this quarter, and what delivers confidence in the face of economic uncertainty. It's not all the way guidance increases across the board. I'm sure he's talking about a specific metric, but they did they actually lowered the top end of revenue. Anyway, beyond commercial wins, We kept busy this quarter by further optimizing our organization structure, integrating and realizing synergies from past acquisitions, alongside meaningful investments into our internal systems, AI. There we go, stock should run, and a continued focus on our Shift4 way principles, deleting parts, staying flat, radical ownership, and executing with urgency. The results of this can be seen in our ongoing strong margins, even alongside the drags of the recent acquisitions. This quarter, we have endeavored to give the people what they want and address some of our most frequently asked investor questions. Throughout this presentation and remarks, we will provide a list of wins to support our beat and guidance raise quarter. You do that every quarter. A contract volume backlog from enterprise clients to support our forecast. Greater insights into our gross revenue less network fees, inorganic or organic composition. As stated earlier in the year, we expect full year 2024 organic revenue growth to be well north of 25%. Q2 organic was 24%, and we expect a healthy acceleration in the back half. Gotcha. A look back on two recent acquisitions, Focus and Venue Next, so investors can get a better sense of our playbook in action. If you read through my previous letters, I go typically beyond our normal results and try to help shareholders really understand who we are as an organization. There are winners and losers in payments. The losers provide little value beyond the approval and decline of credit card transactions, and as a result, there's very little that they can charge for that service. The winners are bringing together software and payments to deliver a more powerful commerce experience, and they can typically charge more for the value that's being delivered. At Shift4, more than 99.9% of our transactions are integrated into software. Predominantly card present, which is not easy. And in verticals that require a lot of software to adequately serve, it is important to realize that there's not a single restaurant, hotel, or sports stadium, or theme park switching to an inferior commerce solution solely to save a few basis points. I want to get past some of this. Yeah, so Jared Isaacman has actually answered a lot of questions on my own, X conversations around Shift4 about this exact question. So I want to read this. The vast majority of our revenue is in fact generated from organic incentives, such as nearly all of our payment revenue, which we have learned is not to take the risk of sitting on our hands and waiting for business to come to us when the opportunity is blatantly obvious. When we do elect to buy, we are finding overlooked assets with high conviction revenue synergies. We then blow up the legacy revenue streams and quickly pivot the business towards a bundled payment strategy, resulting in all the legacy revenue being replaced with a new reoccurring model that we uniquely unlocked. And if you think good companies don't do M&A, check out the hundreds of acquisitions Apple, Amazon, Meta, Microsoft, Google, Palo Alto, and others have completed when capitalizing on an industry in transition. I mean, that's very well said. Even with a great industry giant such as Fiserv, achieve so much of their distribution, vertical specialization, and even the Clover product itself through intelligent acquisitions. I mean, there you go. Why do we do M&A better? Our corporate DNA is about winning. We want to win as much as we can, deploying the fewest dollars with the absolute highest returns. This is because we were never coddled by VCs. We never had a Series A, B, or C, and we never took on any outside capital for the first 15 years of business. If we wanted to hire employees, invest in a project, or acquire an asset, we funded it on our own cash flows. I'd rather deploy capital on high-end or on high probability outcomes than throw it at digital marketing, mass hiring, or hoping for the best. At Shift4, we are simply forged differently. We have a bold team that understands the plan, and when it comes to M&A, we have a winning playbook. We don't win banker auctions. We find overlooked and attractively priced assets through our own proprietary process. We confidently underwrite revenue strategies by cross-selling or bundling payments. We blow up the existing revenue model, one-time software, hardware sales, etc., and often take step backwards to run far forward-leaning with an integrated payment offering. They actually show some pretty amazing slides down below. We aggressively delete parts. Parts can be legacy products, internal systems, or other costly expenses that don't fit within our plan. And we align the talent and distribution with our strategy, enhance the value proposition with payments, and win without delay. Love this shareholder letter. Another thing too, I had someone reach out to me saying I tried Shift4's product and they didn't like it. They said it sucked, and they ended up moving to Toast. I said, "What product was this? Was this Shift4, or sorry, was this SkyTab, or were you using one of their legacy products?" They said, "Oh no, we were using Revel." I was like, "Dude, you're using 100% someone else's product. They're going to go through and get rid of all of that and replace it with their own technology. You did not use a Shift4 product. You used something that they just acquired like this freaking quarter." I want to read through this, but we're running out of time. There's only 3 minutes. I haven't even talked about any of the numbers. So, okay, wait. This is actually on the acquisition of Revel. On this note, this past quarter, we have completed the acquisition of Revel. Revel provides talent distribution and billions in payment volume to cross-sell and eventually move to SkyTab. Okay? We expect Revel, which has historically been a cash burner, to deliver $15 million of EBITDA in the back half of 2024. That's fast. And be deleveraging inside of 24 months. Also, after more than 18 months of work, we announced the acquisition and majority closing of Vectron, which is a German payments company. This deal really highlights our M&A formula at its finest. The transaction provides massive scale in support of our European expansion strategy. Vectron has over 65,000 installed restaurants and 300 distribution partners across Europe. With the support of the management team, we'll blow up the past revenue model, cross-sell restaurant and hotel payments, enhance the value proposition of our current offerings, and eventually pivot the customers to SkyTab. Like, gotta love it. Okay, well, I appreciate investors want simplicity. As the largest shareholder, I am highly motivated to play out our strengths and take bold, calculated risks to win. As the largest shareholder, please, guys, take a step back. Let me do this. I'll take care of this from here. Okay, let's see. So we have a significant backlog of merchants whose volume opportunity is not yet fully actualized. 25 billion worth of backlogs that they're just slowly clicking on over into the platform. Wow. These are some of their highlights. I don't care as much for this. I mean, it's great, but it's not nearly. It's cool that they got Nobu, though. That's super popular. Every stadium. Okay. They're getting into gaming now, a lot of lottery and gambling stuff. So expanding into another vertical. This will be interesting, right? Because everyone goes, oh, well, how big is the industry for stadiums? How big is it for resorts? How big is it for restaurants? Well, they continue to expand. They're in Fiji now, the Maldives, going to, Africa. And the reason why they're picking these places is not that they just simply are like, oh, what's the next small country that we can go and grab up? That's actually not the case. What they're doing is they have partners in North America and Europe. And these people are saying, hey, you service all of our stadiums, all of our resorts, but we also have a resort in Fiji. We also have a resort in the Maldives. Can you end up processing that as well? And so that's actually making them do all of the regulatory work to help those one customer. Then, now that they've already gotten that done, they can then cross-sell to other resorts that may be at the Maldives or Fiji or something along those lines. Here's some international wins. Very exciting. I can't wait to add that to the. Oh, I got to switch over to the call. Ah! All right. Switching. Okay. Got it. Hasn't started. Don't worry.
Over to Tom McCrowan, Executive Vice President, Investor Relations. Thank you. You may begin.
Thank you, operator. Good morning, everyone, and welcome to Shift4's second quarter 2024 earnings conference call. With me on the call today are Jared Isaacman, Shift4's Chief Executive Officer, Taylor Lauber, President, and Nancy Disman, our Chief Financial Officer. This call is being webcast on the Investor Relations section of our website, which can be found at investors.shift4.com. Today's call is also being simulcast on X Spaces, formerly known as Twitter, which can be accessed through our corporate Twitter account at Shift4. Our quarterly shareholder letter, quarterly financial results, and other materials related to our quarterly results have all been posted to our IR website. Our call and earnings materials today include forward-looking statements. These statements are not guarantees of future performance, and our actual results could differ materially as a result of certain risks, uncertainties, and many important factors. Additional information concerning those factors is available in our most recent reports on Forms 10-K and 10-Q, which you can find on the SEC's website and the Investor Relations section of our corporate website. For any non-GAAP financial information discussed on this call, the related GAAP measures and reconciliations are available in today's quarterly shareholder letter. With that, let me turn the call over to Jared. Jared?
Thanks, Tom. This is once again a very busy quarter, and I'm reasonably pleased with our quarterly results and the momentum we have heading into the back half of the year. As a quick summary, we outperformed our financial KPI goals for the quarter. We closed on 2 acquisitions, Rebel and Vectron. We continued our organic international expansion efforts in support of our very large strategic customer, and we won thousands of new hotels, restaurants, and stadiums here in the U.S. and internationally. So on to the quarterly results. For the second quarter, we generated 50% year-over-year growth in end-to-end payment volume, 38% growth in gross profit, and 41% growth in gross revenue less network fees. We also generated $162 million of adjusted EBITDA, representing 48% year-over-year growth as our margins expanded 240 basis points to 51% versus the corresponding quarter a year ago. Our operating margins expanded despite the margin drag from the acquisitions of Appetize and FINRA, which together negatively impacted our margins by approximately 250 basis points for the quarter. Now, naturally, as synergies are realized, we expect that the drag from those acquisitions to disappear and contribute to our ongoing margin expansion targets. Most importantly, we generated $76 million of adjusted free cash flow, up 18% versus a year ago. Our blended spreads also remain very stable, coming in at approximately 62 basis points despite considerable volume growth. Now, with the aim of being a bit more succinct compared to some of my prior prepared remarks, I wanted to share the following highlights. Now, starting with our core, our signature win this quarter is Whistler Blackcomb, which is part of Vail Resorts, as well as new hospitality properties, Nobu Chicago and Nobu Toronto. We also signed Pier 66 Resort, Yosemite National Park, Scott Resort and Spa, Cobblestone Inn and Suites, Amerant Ocean Resort, Deer Valley, Valley Stein Eckstein Lodge, Mount Airy Casino and Resort, and the new live casino and hotel that is currently under construction and scheduled to open next year in Louisiana. I've taken a close look at our pipeline of major enterprise resorts, many of which have never before been on our gateway, and it's nothing short of impressive. So for those that like to poke on our organic versus inorganic debate, these wins represent billions in net new volume at some of the most desirable hospitality locations in the country. And if you're paying attention, we cover a list like this every single quarter. So now, turning to restaurants, which I feel like at times we should not even talk about, because if we were simply known as the toast of hotels and stadiums, we'd probably be more appropriately valued. But the reality is our SkyTab growth continues to accelerate with nearly 10,500 system installs in Q2, representing 12% increase quarter over quarter. Now, we attribute our SkyTab success to A, it's a feature-rich cloud product with strong mobile and online ordering solutions. B, it's the lowest cost of ownership with the philosophy not to charge for every single module and feature. Strong distribution coverage, though we could always use more between our direct and indirect teams, and a strategy that delivers a low customer acquisition cost through referral programs, lead incentives, and intelligent M&A. Now, at current Q2 run rates, we will far exceed our 2024 system installation goals. And if you have any doubt about the momentum of SkyTab, just check out our daily posts on X or Twitter. Some of the more notable restaurant wins, and we post those results like every day on Twitter, so you can really kind of verify firsthand some really awesome restaurants and new startups. It's really going well. Now, some of the more notable restaurant wins this quarter include Experience XRG, which is an operator of 11 distinct Mexican restaurant concepts. Alpaca Chicken, which is fast casual with 16 locations. Stanford Hotels, which will now deploy our SkyTab mobile devices across restaurants at 13 of their locations. Angie's Lobster, which is an Arizona-based fast casual chain. The Casa Cipriani Club, located in Lower Manhattan. Two Gabbiano Restaurant, Shuck and Shack Oyster Bar Group, which is converting 18 of their locations to SkyTab, and Tulacapi Restaurant located in California. In specialty retail, we added Turner's Outdoorsman, which is a 13-store hunting and fishing specialty store chain located in Southern California and Arizona, and the university bookstores for BYU and West Los Angeles College Wildcats. Now, turning to some of our newer verticals, in sports and entertainment, we had a really strong quarter of signings, including the Miami Heat, the Indianapolis Colts, which also includes ticketing, the Chicago Bears, the Indiana Pacers, which has also got ticketing, the Memphis Grizzlies, the AAA team for the Oakland A's, which is and the Las Vegas Aviators, and the Lehigh Valley Phantoms, which is the minor league team for the Philadelphia Flyers. We also signed several college teams, including the University of Houston, Boise State and their famous Smurf turf, Indiana University, as well as a couple MLS teams, the San Diego Football Club, the Austin Football Club. Additionally, we signed agreements with the New England Patriots to provide fans with a checkout-free concession experience at Gillette Stadium. Now, 5 of these sports teams, as I mentioned, came in with ticketing, but just to reiterate, it's the Colts, the Pacers, Austin Football Club, San Diego Football Club, and the Las Vegas Aviators. Now, turning to nonprofits. The overall volume contribution from the vertical is ramped up really nicely this year. So in the first half of this year, we processed more volume than all of last year combined. We expect the second half of this year to be even stronger given the typical seasonal nature of donations, including during an election cycle that occur typically in the fourth quarter. And we're really on track to deliver 400% year-over-year volume growth in the nonprofit vertical in 2024, minus St. Jude Children's Research Hospital, which is already a very large, billion-dollar-plus established customer. Now, the volume growth was driven really by just winning a lot. Our strategy and differentiated value prop as the go-to payment processor for fundraising platforms continues to gain traction and market acceptance. This month, we fully moved all U.S. card volume from Give and Gain to Shift4 payments, and we're going to move their non-U.S. volume later this summer. Give and Gain supports a variety of high-profile fundraising events. So, for example, we're pretty excited to be powering the payments for the Boston Marathon going forward. We also made great progress in our integration with fundraising platform Give Lively, and we're scheduled to go live with our initial merchants by year-end, and we expect volumes from these fundraising platforms to ramp really significantly over the coming months. So outside of the fundraising partnerships, we've also just signed a lot of impressive nonprofit customers like Malala Fund, Amnesty International, the James Hutton Institute, OSF Healthcare, Migrant Help UK, Centrepoint Soho, and World Vision Canada. Now, moving on to gaming. We continue to roll out our SkyTab mobile devices at BetMGM Sportsbook locations, and we're now live at Great American Ballpark, which is home of the Cincinnati Reds. Next month, we're going live at State Farm Stadium, which is home of the Arizona Cardinals. And by the end of this year, we're going to be live in all 24 BetMGM Sportsbooks locations across 9 states, including the locations located within the casinos in Nevada. In online gaming, we expand our relationship with Lotto.com for the Massachusetts State Lottery and signed several new gaming clients, including Prime Sports Betting, where we're going to offer their platform in the state of New Jersey. We also signed sports wagering platform Jack Entertainment and lottery courier Lotto for the state of Texas. Okay, moving on to international. We've made a lot of progress here. So, for example, we followed our most important strategic customer into several new markets, including Fiji and our first African country, Sierra Leone. By the end of this year, we expect to organically expand into 8 to 12 additional countries in Africa, as well as Moldova, and countries located in Asia Pacific, notably Sri Lanka and the Maldives. So we're very pleased with the progress of this important relationship. We attribute a lot of it to the prior FINRA acquisition, as we're now able to expand internationally in a very organic way. Now, in Europe, we continue our momentum serving electric vehicle charging stations. We're now processing payments in 12 countries serving this vertical. So our right to win in this market is due to our early mover advantage and integrations with multiple players within the ecosystem, our investment certifying the most EV-ready devices, including strategic relationships with various hardware providers, and really unique feature functionality to support the electric vehicle use case, like incremental authorizations that we use in our resorts. So today we have a very turnkey EV charging station solution, and it's no wonder why we're growing so quickly within that lane. Now, continuing on with our international results, we signed the prestigious Bombay Hotel in Tallinn, Estonia, the Italian jewelry and watch retailer Binda Group, and German online travel agency Travel Store, where we'll process transactions for their Holiday Heroes brand in Germany. We also entered into an agreement to process payments for Portugal's PayShop, which is a utility bill payment provider with over 7,000 locations throughout Portugal. We signed KM Air, which is formerly Air Malta. We signed Danish ski equipment retailer eSporteller APS and Danish LED developer BMD Trading APS. We're also boarding over 300 merchants per month in Germany, the Nordics, and soon Italy through our partnership with FlatPay. And we continue to grow our wallet share with major European delivery company Wolt, which is owned by DoorDash, recently adding Albania to the list of more than 15 countries where we power their payments in Europe. Again, these are all newly contracted relationships, and the revenue associated with this laundry list of wins that I rattle off each quarter are purely organic. So moving on to capital allocation. So first, we closed on 2 acquisitions during the quarter that are going to deliver very meaningful synergies. So starting with Revel, this is a proprietarily sourced transaction and very much follows the Shift4 playbook. So the opportunity includes a massive payment cross-sell, deleting duplicative products or parts, and reducing associated costs, along with arming distribution to sell SkyTab in multiple markets beyond just the United States. Now, the talent from Revel will accelerate SkyTab capabilities in quick service, retail, and they have some awesome enterprise offerings, along with localization in several international markets that they've already been serving. So a big accelerant to SkyTab. And as we previously communicated, despite Revel having been a cash burner since the company's inception, we expect Revel synergies to contribute approximately $15 million of adjusted EBITDA in the back half of 2024. Now, like Revel, Vectron is another fine example of the Shift4 playbook. Proprietarily sourced transaction that we've been working on for some time now. So we recognize this monumental value unlock opportunity in the business. And as I mentioned, we spent 18 months working on this transaction. Vectron software powers over 65,000 merchants, predominantly restaurants, and is distributed by 300 plus dealers in Central Europe. The deal delivers a huge install base to cross-sell payments and eventually upgrade to SkyTab. We've got hundreds of distribution partners to pursue restaurant and hospitality opportunities across Europe, and the talent and infrastructure to approach the market at scale. So unlike Revel, though, where we have a more immediate impact on the business, we expect the opportunity with Vectron to develop over time. And this is predominantly because of the longer closing and delisting process in Germany. Now, like similar deals in the past, we are definitely going to take several steps backwards to ultimately sprint very far forward over the years to come. So it should be clear, though, Vectron delivers a guaranteed path to scale and distribution and has completely de-risked our SkyTab restaurant production goals in Europe. Vectron also positions us to benefit from the anticipated secular shift to card-based payments throughout many European countries like Germany. So as some of you may know, MasterCard just recently called out this opportunity specifically in Europe just last week during their Q2 earnings call. And we agree, the overall digitization of commerce is influencing consumer behavior throughout Europe towards a more integrated and digital payment experience, and we are now positioned very, very well to lead that evolution and benefit from it. Also, as mentioned in my letter, we are not going to sit on our hands and wait for the business to come our way when the opportunity is really obvious. You know, some of the greatest tech companies were formed by deploying capital intelligently while a market was in transition. I mean, there are literally hundreds of examples that can be found inside Amazon, Microsoft, Apple, Meta, Palo Alto. Even payment companies like Fiserv and their Clover product have benefited from intelligent M&A. So we've delivered a lot of winning transactions. We're very good at it. And Revel and Extron will be winners, and there's going to be more like them. Second, we did repurchase over $35 million of our equity since implementing our $500 million buyback authorization last quarter. And we have ample free cash flow to fund additional buybacks and acquisitions. So Nancy's going to talk a little bit more about our leverage and balance sheet in her prepared remarks. Third, while we have many organic investments underway, we have become increasingly encouraged by recent momentum and have begun making incremental investments to accelerate our progress with SkyTab and our international expansion efforts. Further, it's no secret I would like to see Shift4 become essentially the SpaceX of fintech. We have been funding major internal system initiatives, including our new Mission Control Center, Project Phoenix, and AI initiatives, where we will endeavor to take the innovation magic and the no-fail SpaceX approach and apply it to our operations all over the world. Now, in terms of investor feedback, you know, we receive a lot of questions and feedback from investors and have attempted to really answer many of them in my shareholder letter, the earnings presentation, and throughout our prepared remarks. So for example, this quarter, you should find further explanation of our build, buy, partner strategy to capitalize on what we believe to be a massive opportunity as software and payments converges to deliver a superior commerce experience. You should also find a breakdown of our M&A formula, including how we delete legacy parts, blow up the revenue model, enhance the value proposition, and pivot the revenue model towards payments plus SaaS. Taylor is also going to provide further proof points at this point as he walks you through past acquisitions, including VenueNext and FocusPOS. And as mentioned in prior quarters, there are many things we can control in our operations, but oftentimes the timing of enterprise go-lives is beyond our control. As such, we have shared our contractual backlog of volume, the majority of which is expected to go live in Q3 and Q4, and we use this to sense check our own projections. Last, we have provided the inorganic contribution to Q2 gross revenue less network fees, along with reiterating that the full year of 2024 should be well north of 25%. Now, in closing, for the 11th time in 17 quarters that we've been public, we have positively revised guidance. The guidance update this quarter accounts for the overall outperformance from the quarter, the legacy and synergy contributions from Revel and Vectron, as well as notable incremental investments to accelerate the pace of progress with internal systems, AI, international market expansion, and SkyTab product accelerants. Now, in the face of some economic uncertainty, I'd like to think our guide demonstrates the strength of our diversified business model and our strategy. So consider this. Despite the relentless comparisons, we do a lot more than just restaurants at Shift4. We do not offer capital or funding programs, and we generally target established businesses that have less failure risk. We have focused on an efficient and low-cost customer acquisition model by acquiring overlooked assets and cross-selling our products and services. As a result, we can grow through even the most challenging of economic times, and often without having to win a single new customer. And this is not a believe me story. We have been there before and grown through .com, the Great Recession, grown through the pandemic and pullback, and we're going to continue to do so for years into the future. We have the most enviable roster of clients and have consistently announced high caliber wins each and every quarter since we went public. We intentionally serve complex merchants in challenging card-present verticals where our platform, product, and software integrations provide an impressive moat. And as a result, we possess a differentiated right to win and have done a pretty good job identifying acquisitions that either extend our technology capabilities for purposes of entering new markets, or just add merchants and distribution capabilities at an attractive customer's acquisition cost alongside equally attractive payback periods. We have a unique playbook and formula that delivers successful results in sharp contrast to our peers. As a result, we are delivering consistently strong growth while expanding our operating margins and generating strong free cash flow. We have a proven strategy centered around software integrated payments, and we are well on our way to replicating our success in the USA all over the world. And with that, I'm going to turn the call over to Taylor. Taylor.
Thanks, Jared. As in prior quarters, I'm going to spend a bit of time talking about the current operating environment, but I'd also like to talk about our backlog and provide detailed insight into a couple of recent acquisitions to demonstrate how we unlock value from M&A. Starting with the operating environment, we do our best during times of economic uncertainty, and now is no different. Merchant growth and same-store sales performance was generally within our expectations during Q2. It is important to note that despite the constant comparison to others in the industry, we are well diversified, and we've never relied on same-store sales for our growth. This diversification was a commitment we made at our IPO, and has increased our resiliency even while growing our total volumes at a 75% CAGR in the 4 years since IPO. As many of you know, we have been cautious that the $100 steak would not last forever, and it appears that restaurants may be experiencing a mild slowdown. On the contrary, hotel travel, stadium attendance, and retail merchants are all doing reasonably well, and we continue to add lots of merchants. These conditions favor Shift4 as we grow by aggressively taking share across and cross-selling payments and software. This works quite well as our products are competitively priced and have low fixed cost of ownership, which is attractive to merchants. Our strong balance sheet and free cash flow also allow us the flexibility to grow when others are shrinking. We use these times to invest in our business, building, buying, and partnering at a time when many in our industry are urgently trying to prove they can even achieve a modest profit margin. Jared provided a thorough rundown of the various drivers underpinning the step up in growth for the back half, and I wanted to highlight our backlog, which is a metric we track internally and helped inform our guidance. Our current backlog is roughly $25 billion in volume. This represents volume that is already contracted but not yet implemented or at its expected run rate. While there can be slippage from time to time, these merchants are either already installed or have an installation that is scheduled in the near term. It is important to realize that this is one of many factors that contribute to our confidence in volume growth for the back half of the year. For example, we signed thousands of restaurants, hotels, and e-commerce customers, nonprofits, and others that will go live immediately. When you see this number, you should think of sports stadiums and enterprise resorts that have signed contractual commitments, but for a variety of reasons, such as waiting for the season to start or the resort to open, they have not gone live yet. As Jared mentioned, we expect the majority of this volume to be realized this year. Given our recent acquisitions, I thought it would be helpful to provide some insight into two of our more seasoned acquisitions, VenueNext and FocusPOS, in order to give you all a little better perspective on how the revenue model for these two companies evolved over time. In short, both companies experienced a dip in revenue shortly after acquisition. This is planned for and deliberate as we transition their models and bundle payment processing and SaaS. For FocusPOS, their legacy revenue model was very dependent on one-time revenue, with about 2/3 of their revenue being non-recurring in nature. As a result, in the first 2 months post-acquisition, their gross revenue less network fees declined about 54% as we executed on our typical strategy of blowing up the legacy model and pivoted to a bundled payment solution. Today, FocusPOS gross revenue less network fees is 95% recurring in nature and is 5x higher than their post-acquisition lows and 3x higher than pre-acquisition levels. Because we are bundling services that merchants traditionally use multiple vendors for, they are often saving money and getting a dramatically improved service experience. It's a win-win. I'm sure you can see the similarities between FocusPOS and Vectron. Vectron is a business that will take some steps back in revenue and EBITDA for the remainder of the year, but in the spirit of delivering payments plus software value proposition that should lead to very meaningful revenue, EBITDA, and free cash flow growth over the medium term. With VenueNext, we also took a step back in revenue contribution before taking many steps forward. legacy VenueNext already had a recurring revenue model built on SaaS, although they did also rely on one-time hardware sales. We were able to complement VenueNext's superior technology with our distribution and offer this end market a bundled payment solution that was very novel at the time. Post-acquisition, VenueNext similarly witnessed a temporary dip in gross revenue less network fees as we transitioned away from one-time hardware sales and towards payments, with VenueNext today generating gross revenue less network fees that is greater than 7 times pre-acquisition levels, of which 90% is recurring in nature. It took some time to educate the markets on the benefits of this bundled solution, and today we are now reaping those benefits. Volume from stadium and entertainment clients was up over 50% year over year, with a considerable runway to capture additional share of wallet as we cross-sell ticketing to the installed base. We've put illustrations in our latest shareholder letter to help better visualize the trends mentioned here. In both of these examples, as with the majority of all other M&A, we don't saddle our businesses with technical debt, layers of bureaucracy, unnecessary parts. Focus POS and VenueNext integrated to our payment platform alongside of 500 other ISVs, go to market with a new SaaS plus embedded payments offering, and win more in their respective markets as a result. While we talked about a small handful of examples, it's worth noting that the broader opportunity set is growing as well. Our pipeline of compelling opportunities is, quite frankly, larger than it's been at any point in recent history, and we're in the enviable position of being very picky about what we spend our time and capital on. Now, while we've spent a fair amount of time talking about M&A in this quarter, it's important to realize that we don't have to do deals, and we have conviction in the balance of our build, buy, and partner approach. As Jared mentioned, we did not do a single acquisition in our first 15 years in business and grew quite quickly. What we are not content to do is sit back and wait for business to come to us when there is still so much opportunity to accelerate the convergence of software and payments. And with that, I will turn it over to Nancy to discuss our financial results. Thank you.
Thanks, Taylor, and good morning, everyone. We delivered another quarter of consistent and solid results, outperforming our quarterly guidance and demonstrating again our ability to deliver top-line growth while continuing to drive margin expansion and strong free cash flow conversion. Total Q2 volume of $40 billion grew 50% year over year. Gross revenue less network fees grew 41% to $321 million. Our adjusted EBITDA for the quarter was $162 million, up 48%, and adjusted EBITDA margins expanded 240 basis points to 51% versus the same quarter last year. Excluding the impact of the legacy FINRA and Appetize businesses, margins expanded more than 500 basis points. Our quarterly results were driven by the continued strength of our hospitality and restaurant verticals, momentum across our enterprise merchants, further monetization and conversion of gateway customers, and an increasingly larger contribution from stadiums and ticketing. We see the impact in both our payments-based revenue growth and the increased contribution from SaaS-based fees. Organic revenue for the quarter was 24%, and we are reiterating organic growth to be well north of 25% on a full-year basis. The in-quarter contributions from Revel and Vectron were immaterial, given both acquisitions closed in mid-June. Blended spreads for the second quarter and the first half of the year was 62 basis points. Spreads across our core business of restaurant, hospitality, and specialty retail continue to remain stable. Based on our year-to-date performance and the vertical mix and customer size driving our volume, we now expect full-year spreads to average no less than 61 basis points for the full year, up from the 60 basis points floor we provided previously. Subscription and other revenue was $71 million in Q2, up 93% compared to the same period last year. The growth in SaaS and other related software revenue was driven by our success across SMB, SkyTab, and penetrating the sports and entertainment vertical. Growth in subscription and other revenue will not always be linear. This is a good opportunity to remind investors that, as Jared and Taylor discussed, we often blow up the legacy revenue model of our acquisitions and pivot them towards our signature Shift4 payments-fueled value proposition. Our continued success in converting Appetize and other software-only clients to acquiring will cause subscription and other revenue to decline and offset some of the outsized growth we are achieving. Additionally, the timing of one-time revenue may cause some bumpiness quarter to quarter. In Q2, total general and administrative expenses increased 34% year over year to $110 million. Excluding the impact of the acquisitions, though, completed in Q4 last year, G&A expenses were flat year over year. We remain highly committed to a disciplined approach to cost management while continuing strategic investment for growth. As Jared mentioned, we are making incremental investments in areas we see further opportunity. But overall, our goal of keeping headcount flat while investing in talent upgrades remains in place. We are quickly progressing on the overhaul of our operating model, which will further drive efficiency and scalability across our platform. Our second quarter adjusted EBITDA margins were 51%, representing 240 basis points of expansion compared to Q2 2023. As I mentioned, excluding the impact of acquisitions, margins expanded over 500 basis points. We have high conviction in the many opportunities to further improve our underlying margins that are still on the horizon, including the remaining M&A synergies to be realized from our ongoing integration efforts of recent M&A, utilization of AI technology, implementation of new internal systems, and ongoing streamlining efforts to enhance scalability throughout our business operations. Our adjusted free cash flow in the quarter was $76 million, up 18% compared to a year ago. As a reminder, Q2 cash outflows include a semi-annual interest payment of roughly $10.4 million, which can distort the quarter-to-quarter sequential comparisons. Total adjusted free cash flow conversion for the first half of the year is 54%, in line with our expectations. In addition to the timing of interest payments, there will be fluctuations in our conversion rates on a quarterly basis due to the seasonality of our business, the deployment of capital to support growth, and normal working capital cycle changes period to period. Overall, the improvement in our unit economics and efficient operating model continue to give us great confidence in our ability to deliver annual year-over-year expansion in our adjusted free cash flow conversion rate in line with our previous guide of 60% plus. I will talk about the slight drag we expect from our recent acquisitions in just a moment with our updated guidance. And with respect to capital transactions, in May, our board of directors authorized a new stock repurchase program, pursuant to which we are authorized to repurchase up to $500 million of common stock through December 31st, 2025. During the second quarter, we repurchased approximately 230,000 shares for approximately $16 million, leaving approximately $484 million of capacity available as of June 30th. To date in Q3, we have repurchased an additional 300,000 shares for approximately $20 million, and we will continue to be opportunistic. You can find a complete reconciliation of our shares in the back of our earnings materials. We have cumulatively deployed approximately $350 million on buybacks, repurchasing 6.5 million shares at an average price of $54 since our IPO. Of note, cumulative dilution from our stock-based compensation has been less than 2% per year on average. As employees, we are the largest shareholder of Shift4 and are very thoughtful about managing dilution. Net income for the second quarter was $54.5 million. Diluted earnings per Class A and Class C share was 58 cents. Adjusted net income for the quarter was $89 million, or 96 cents per A and C share on a diluted basis, on 93 million average fully diluted shares outstanding. Our balance sheet remains strong. Our sequential decline in liquidity is due to the cash purchases of Vectron and Revel. Our total indebtedness has a weighted average cost of 1.35%, and we do not have any maturities until December 2025. Our net leverage at quarter end was approximately 2.7 times. Excluding the impact of lower cash due to the acquisitions we just completed, net leverage dropped to 2.2 times, our lowest level since January 2021. The deleveraging profile has been quite extraordinary. Our strong balance sheet, growing EBITDA, and expanding free cash flow conversion afford us many options to fund strategic priorities, opportunistically buy back stock, and satisfy year-end 2025 maturities without being punitive to our equity. Now turning to guidance. We are updating our full-year guidance to include Q2 outperformance and the contribution from Revel and Vectron, which both closed on June 13th. As Taylor just elaborated, we expect to pivot the revenue model of both companies to payments as we cross-sell payment processing to the installed base of merchants. For the full year 2024, we are further tightening our guidance range for end-to-end volume and now expect a range of $167 billion to $172 billion, representing 53% to 58% year-over-year growth. We are increasing our gross revenue less network fees range and now expect the range to be $1.35 billion to $1.38 billion, representing 44% to 47% year-over-year growth. We are also increasing our adjusted EBITDA range and now expect adjusted EBITDA to be in the range of $662 million to $689 million. The year-over-year margin expansion remains virtually unchanged from prior guidance, despite the incremental investments we are making in Europe. We are also resetting our adjusted free cash flow conversion expectation to 59% from 60% previously to account for the drag from recent M&A. We estimate this yields $399 million of adjusted free cash flow for full year 2024 at the midpoint of our adjusted EBITDA guidance. We continue to expect organic growth of gross revenue less network fees to be well north of 25% at the midpoint of our full year guide and are also updating our quarterly breakdown of our annual guidance to help investors better understand the impact of seasonality on our business, which can be found on page 22 of our shareholder letter. A couple of call-outs as it pertains to our guidance. We continue to expect a stronger second half of 2024. A long list of low-hanging fruit cross-sell payments and SkyTab, including from our recent acquisition of Revel. Contracted annual volume backlog of about $25 billion that Taylor discussed that is already contracted, but not yet implemented or at its expected run rate. SkyTab system installs continue to accelerate each quarter, and we are way ahead of schedule on our 30,000 goal for 2024. Many of the wins featured each quarter, especially stadiums, ticketing opportunities, major enterprise resorts, are seasonally strongest in the back half of the year. Strong progress in Canada, including our signature win this quarter at Whistler Blackcomb and Nobu Toronto. This was previously an untouched market for Shift4. Real momentum in Europe, as demonstrated by the impressive list of hotel and restaurant wins we have shared over the last few quarters. And while it won't be a real driver of the balance of the year, we are really excited about the Vectron acquisition and what it brings. Our strategic e-commerce customer continues to add volume quickly, and we've been expanding organically into several new international markets with at least 8 new countries set to go live in the back half of the year. The high end of our volume guide, which we have tightened in light of the delayed Vectron closing and control process, and clearly a consumer that is not at peak spending, would imply seasonal trends consistent with prior years. It is also worth highlighting that we would have raised the midpoint of our EBITDA guide further if not for the anticipated drag from our European strategy. We have provided an EBITDA bridge on page 23 of our earnings. For even further clarity, even without the recent acquisitions, we would have raised the midpoint of our guidance to account for Q2 outperformance. Before turning the call back to Jared, I want to reiterate that our balance sheet, cash generation, and profitable growth position us incredibly well for the current environment of macro uncertainty. With that, let me now turn the call back to Jared.
Thanks, Nancy. So before we go to the line for questions, we are going to take, it's a multi-part question that was submitted over X. So Tanner Triggs, you've got the lucky pull here, and it's actually like 4 really awesome questions. So I'll try and hit it really quickly. Now that we've been playing the kind of the carrot and stick game on our gateway business for some time now, what does the future organic trajectory of the business look like? Well, first I'd say the power in our gateway goes well beyond just the volume that's on it. It's those 550 plus software integrations that allow us to pursue these verticals that few others can. So great examples this quarter would be like Nobu Toronto, Nobu Chicago. They were never on our gateway at all, but they require those integrations. We had the better value prop versus the other two that could compete for that business, and we won. But you think about it, our whole stadium vertical right now, I mean, we acquired the software to pursue that vertical several years ago, but we bundled it with our payment offering, and we bundled it now with our ticketing integrations. All of that is organic growth. So, we're taking a lot of products and services like SkyTab, which was an organic initiative, and we're growing really quickly in the U.S. with them, and now we're able to do it in Canada and Europe. So, from my perspective, like the organic growth trajectory of the business is going to be extraordinarily long after the gateway conversion story plays out. You had a couple other things about how easy it is to take our products and services that work in the U.S. into Europe, and that depends. So SkyTab has been in the UK and Ireland for some time right now. There's very little localization or fiscal compliance that's required there, versus it takes more time to localize SkyTab, say in France, for example, or Germany. But those are all efforts that are underway. The software integrations that we have that power hotels, for example, say Oracle or Agilysys, they work in Europe the same as they do in the U.S., and they work in Canada the same as they do in the U.S. Our VenueNext software for supporting stadiums is pretty plug and play in Europe, and I think that goes to the last part of your question, which was specific to stadiums in Europe. Actually, you have a couple more parts to it, but we're making great progress. I think we posted on Twitter a cool video of our first stadium that went live in the UK. And we're working on a pretty badass video for the FC Barcelona go live, which is underway as well. So I don't think the actual go live process for stadiums in Europe take any longer than they do in the US. You just got to wait for the season to end. And here's the last part, which I think is a good one, is that every now and then we talk about wins that are kind of outside the core of restaurants and hotels and stadiums. You used examples like the UPS stores or Fanatics or self-storage, and kind of like, what's the trajectory like there? And the interesting thing is, these are just businesses that use the same integrations that we use to pursue, hospitality customers. So think about it, big hotels and resorts have retail shops in it, like, I don't know, Caesar's Forum shops and such. And then other retailers use the same software. So we have a lot of ski resorts. Whistler Blackcomb is a great example this quarter. But we also have a lot of like ski shops that use the same software that ski resorts would. And the same retail software that, say, customers in the forum shops use is what UPS stores uses. It might be the same software that Fanatics uses or merchandising shops. So it's actually like not really a new vertical for us. It leverages the same integrations that we use to pursue our hospitality line of business. And I appreciate those questions. We'll go to the analyst.
Thank you. If you would like to ask a question, please press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 if you would like to remove your question from the queue. And for participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. We ask that you please limit to one question and one follow-up question. One moment while we pull for questions. Our first question is from Darrin Peller with Wolfe Research. Please proceed.
Hey guys, thanks. Maybe we could just start off looking a little bit more at the acquisition contribution, and then a little more on the strategy and roadmap of how to, your plan to really monetize and make the most of those. And so I know you talked about, some of the guide increase being $15 million in EBITDA, $35 million from revenue from acquisitions. Can you just explain the margin dynamics there first from Revel and Vectron? And then more strategically, Jared, can you just hone in a little more on the roadmap on how to really, what your expectation on milestones are to monetize those in terms of moving some of that software over and moving it over onto payments, and some more, maybe a little more color on the timeline of how you could monetize those deals. Thanks, guys.
Yeah. Hey, Darren. Jared here. Let me kind of start out with some of the high level points, and then I'll kick it over to Nancy to get into any of the specific margin drag dynamics. So, first of all, as we've kind of demonstrated in our earnings reports with the focus pause and the VenueNext look back, we do take a very quick and deliberate approach to pivot the business model of these type of acquisitions. So oftentimes it's forgoing hardware, software revenue, even SaaS revenue we'll throw away if it accelerates a migration. So keep that in mind. I'd say especially with respect to to Vectron, which probably looks a little bit more like some of the deals that we have done in the past, where a heavy concentration of kind of more one-time revenue that can go away very, very quickly when you pivot strategies. Now, let's start with Revel right now. So we said last quarter when we announced that deal that we expect a $15 million contribution for the back half of the year. You should assume almost all of that's coming from cost synergies. Revel was very much a tech startup, big cash burner. We say that we go in very, very deliberately. We burn the ships so that we can focus on the future. The future is SkyTab in our world. So that isn't to say that we don't see a huge opportunity from the 18,000 customers that we're gonna cross-sell payments and eventually move to SkyTab. But these are bigger chain customers. That's going to play out over some period of time. The immediate move is to say, look, we're not actively developing in Revel anymore, and that's some big cost synergies there. That's why I think some people had some questions. Hey, you've got 15 million of EBITDA coming from this thing. Where's the volume associated with it? Hey, we're not really baking that conversion process in right now.
Right.
That'll play out over a couple years. Now, with respect to Vectron, this is where you're going to definitely take a couple steps backwards as you pivot the model. This is going to take this isn't going to play out over 2 years or something like maybe a Revel would. This is a story that's going to play out over 10 years. You have 65,000 customers they're going to be a shoo-in for payments in Europe. You're going to have 300 plus distribution partners that are going to sell, SkyTab all across Europe. But this is all going to take some time to play out. We don't even have full control over this company based on just the delisting process. So hopefully that gives you a little bit of a sense of where the puts and takes are, where you get some drag from some of these businesses, where it can even impact a little bit of free cash flow when you go negative on say like a Vectron, but where the opportunity will play out much, much greater over the years to come. And Nancy, I don't know if you want to add on the margins.
Yeah, I think what I would add is to understand we certainly spent a lot of time looking at this, and I would say the best proxy for consolidated gross margin for the year is Q2. I expect on an all-in basis for it to look very similar to what you're seeing this quarter, with puts and takes of obviously new drag from Revel and Vectron, and we continue to synergize still, with Finaro and advertisement last year. So think about the synergy process as that will sometimes take more than 12 months. So even though we're lapping Finaro, we are certainly still doing lots of integration work there. So that's how I would think about it. Is this thing is going to get a little more complicated, obviously, with our pace of acquisition are kind of blowing up one model and getting them to convert over. So I think starting to give like a good proxy for what to expect the back half of the year, Darren, is probably looking at exactly what we achieved in Q2.
Okay, that's really helpful, guys. Very, very helpful clarification.
Sorry, Darren. I remember it's the first part of a longer question, so I want to make sure we address it. Nancy, do you mind commenting on the it was de minimis, and I think we said that, but just further clarification on revenue contribution from Revel and Vectron in Q2.
Yeah, for sure. I think that's why we wanted to put out the 24% organic, because remember, we only had 2 weeks, and we're talking about something completely immaterial for Q2. So I wouldn't even think about them as a contributor for the quarter. And certainly when you look at the guide raise, we tried to contemplate the benefits going into the back half of the year.
Okay. That's really helpful. And very quickly, the backlog was really helpful to get, guys. Just considering that gives you a lot of idiosyncratic reasons to be confident on the second half. Just any macro conservatism built into the outlook at this point? Or, I mean, I know there's some in terms of same-store sales on certain verticals, but maybe just comment on that and I'll turn it back to the queue. Thanks, guys.
Want me to go?
Yeah, sure.
Yeah. Certainly when we built the original guide, and I think some of the pull down on volume, when we tweaked it a little bit, we were thinking about that. We knew the glory days were not coming, and we've been talking about the prices of the steak were going to bust up at some point. So the way I would think about it is we pulled down the high end, knowing that we wouldn't have kind of any upside. We definitely considered that in the macro. And generally, when we put our low out to begin with, we had some conservatism there. But generally, coming out of Q2, we had a really solid same-store sales. And while we're seeing some softening maybe in early July, it's definitely offset from like really solid performance across the other verticals. So right now, I think we're just kind of holding kind of holding steady for now from a midpoint perspective.
All right. Great results, guys. Thank you.
Thanks.
Our next question is from Dan Dolev with Mizuho Securities. Please proceed.
Hey guys, hey Jared and Taylor, really good results here. I have a quick question about the volume. Can you maybe clarify what drove the volume reduction to the full year guide, and maybe give us a little bit of your sense of confidence into the macro in the second half? That would be great. Thank you so much.
Yeah, I mean, I can start that one off. Nancy, she kind of mentioned in her last remarks, but it really was driven in two parts. One of which is when we put out our volume bridge last year. We put a big slug of restaurants and hotels in Europe in it. And for as much progress as we are making, we're announcing awesome wins every quarter. We didn't have the 65,000 customer layup, that we will eventually have control over in the balance of this year with Vectron. So I think just like, there is some delays in getting to the thousands of restaurants and hotels that we were hoping for this year. The other part is, as Nancy mentioned, is like just the good times aren't rolling anymore. So when we initially set a volume guide at the beginning of the year, we said the upper end is that the $100 stakes continues, though we're always cautious that will have like real staying power. So I think that's just prudent to tighten that up. I will say, generally speaking, on the macro, look, we have grown double digits in volume and revenue our entire history of 25 years. And there's been a lot of downturns throughout that period. If you're growing volume at the pace that we are, it's not to say like, 3% reduction or something in same-store sales in restaurants isn't a factor to consider. It certainly is. And believe me, if there's a restaurant, I think it's all bets off. If there's a recession, I'm sure it's all bets are off for everybody at that point. But from our perspective, like how we're hitting our volume targets is doing smart things, like Vectron and Revel, where I guarantee you it will be a hell of a lot easier for us to predict where our next 65,000 customers are coming from in Europe than it will be, say, for somebody else who's just beginning to enter into that market. And that's how we have like just greater control over the volume trajectory of the business versus, trying to underwrite down to the 100 basis points on a same store sales movement.
Got it. A really good quarter. Thanks again, Jared.
Our next question is from Timothy Chiodo with UBS. Please proceed.
Great. Thank you for taking the question. I want to hit on the stadiums and ticketing wins. There was a really strong list of ads this quarter. Many of them you noted are already starting with ticketing from day one. And you've mentioned also the ongoing cross-selling opportunity. I think a lot of that has to do with the integrations that you've made throughout the ticketing ecosystem with numerous platforms. I think basically all of the major ones. But the question really comes down to that rough TAM. I believe it's in the 100 billion or so range for the US. Maybe you could update or correct that number if I'm off. And giving us a sense on what portion of that you're working with in some way, whether it's only on ticketing or only on concessions, but how much of that do you think you've already achieved as a part of that? Again, let's call it roughly 100 billion TAM. And then if you don't mind, after I have a quick follow-up on mix.
Yeah, sure. So good morning, Tim. This is Taylor. I'll cover that. I think very important to distinguish the two concepts, market share versus wallet share, especially in these like stadium environments where the revenue centers are very fragmented in many regards. So we feel really good about our market share. And these numbers can vary, but whether it's 2/3 or 75% of the stadiums and theme parks in every league in the United States, we have a customer relationship in some way, shape, or form. It's a minority of those where we have kind of the holy grail, which is the entirety of the stadium plus ticketing, as you mentioned. But that is the most common of the offerings that we go to market with now. It's probably the most common of the offerings that's taken from, let's say, a hypothetical appetized stadium moving over to venue next. So we're really enthused, and quite frankly, our customers see a ton of value in giving us, the bulk of the revenue center management and ticketing inside of that. I think the harder part is that the volume comes in reasonably choppy when you do that. At least it takes kind of a year, maybe 2 years to fully season. And the example I would give is, we acquired Appetize in the back, just before the last quarter of of 2023, and we have been installing more stadiums in a month on Venue Next than we have in our busiest quarters in any other year. So pace of installation has been incredible, but from a revenue and volume standpoint, you won't see that until the sports season starts up, and then in the case of ticketing, usually the bulk of ticketing happens after the season when they sell season tickets for the following year. So we feel really good about our market share. We feel really optimistic about the ultimate wallet share. I'd say the choppier part, and this has kind of led to a back half weighted volume expectation throughout our guides through the year, is just that the cadence of that.
Excellent. Thank you for that. The brief follow-up is kind of a pie chart question. So in the shareholder letter, you mentioned that now you're at about a third of volume, 33% from hotels and resorts. If you wouldn't mind just updating what the rest of that pie chart might look like, meaning how much of that is restaurants, stadiums, et cetera, based on the existing base of end-to-end volume.
Yeah, sure. We love this. It's about a third, meaning that you've got restaurants, hotels, and then all other. And all other would include stadiums, but it also includes specialty retail, things like Jared mentioned, our big strategic customer, et cetera. As I mentioned in my scripted remarks, we made a deliberate commitment at the IPO to diversify the business, and that's, I think, paying some dividends today. We do see a modest amount of softness, as Nancy mentioned, very recently in restaurants, but we're seeing none of that in hotels, and we're seeing kind of continued spending across all these other verticals. And we've got a handful of merchants that are growing really nicely inside of that all other bucket, which is great. It offsets kind of any expectation you'd have in the macro.
Perfect. Thank you for taking both.
Our next question is from Will Nance with Goldman Sachs. Please proceed.
Hey guys, appreciate you taking the question. I wanted to ask on the gateway revenues. I know you guys had discussed kind of like a non-standard gateway conversion towards the end of last year, and we saw the I guess what we call the gateway revenues in the model coming down over the last couple of quarters. I think we got to like 1 million or so this quarter. So just could you update us on sort of where we are in that journey, and then just like clarifying, because those revenues appear relatively low now relative to the large base of volume. I realize it's really low take rate, but just kind of making sure that we're understanding the kind of the economics as they exist today on the existing gateway volume.
Yeah. Hey, Will, I'm happy to take that. So there is still a very large quantity of volume that is still there. That we make very, very little off of. So, these are some very big customers that go back to the First Data, JPM, JVs with very long contracts with lots of price protection at very low rates, because during that JV, they chose to monetize the relationship upstream from the gateway. So we're still working through it. It's a lot of volume. There's certainly a lot of like low-hanging fruit in there still to get, smaller customers that contribute to our growth every single quarter. But there's a lot of big ones in there as well, and there has been for some time. And we are very incentivized to cut deals to get them over so we can start sunsetting connections that we don't want to upkeep anymore. So I think like every quarter that goes by, we are more incentivized to want to, delete those old parts. Like we maintain a lot of infrastructure to Heartland, GPN, Fiserv, WorldPay. But yeah, it's a lot of volume at like ridiculously low take rates in there. So that should represent some opportunity, because literally any deal that we cut with them should have some uplift, and obviously it would almost be like 100% flow through, because we're doing a lot of support for those customers.
And Dan, we also try to illustrate this in our shareholder letter. You'll see kind of tags next to a bunch of the different wins that were gateway conversions. As you know, that pulls down gateway revenue, but much to the benefit of end-to-end, volume and revenue. So, it's been a very consistent funnel for us. I wouldn't try to imply in any way that a reduction in revenue there, mitigates meaningfully our opportunity set.
Yeah, no, that all makes perfect sense. And then I guess the second question is just on SkyTab. It seems like the momentum there is really strong, and obviously adding lots of more opportunity with some of the acquisitions that you just did. So just any color, I guess, broad strokes where you are seeing the traction and the deployments, whether that's through direct sales channels, through the existing indirect channels that you still have, as well as if there are any call outs around some of the acquisitions you've done over the past couple of years. Where are you guys seeing the most success in deploying the SkyTab platforms?
Yeah, well, so happy to hit that. I mean, whether it's direct or indirect, it's entirely a factor of just where you're at in the country. So we already, back in 2022, summer of 2022, so more than 2 years ago, we already insourced all of our partners in the markets that we wanted to have a direct presence in. So we haven't done any insourcing in 2 years. So we said those were markets that we were pretty committed to. A lot of production comes from there. And then more on the West Coast and central U.S., more sparsely populated areas, that's where we have third-party distribution, because it's just, we'd rather have the variable cost in that case than the fixed cost. I'd say in the UK, for example, in Ireland, we have a small direct team. We also have a couple partners, and we're just kind of really learning the market there with them. But you can see the results, as we post them on Twitter and X. It's like covers the gamut every day, from startups to like really beautiful restaurants. So we love the traction. There is no, in terms of the legacy brands, going back to 2017 that we acquired, like we deleted those parts. There is no Future Pause production or Harbor Touch production or Posi Touch production. Like everything is SkyTab and has been essentially for 2 years now.
Yeah, makes sense. If you don't mind to follow up, I guess when you think about those legacy brands and the customers that you've had on the platform for a really long time, I guess what's sort of the mix of like backbook conversions versus kind of net new sales?
Yeah, it's almost all net new. So I think we've said a couple times over the quarters, we're enhancing our Lighthouse product, which is our business intelligence platform, to have kind of like iPhone 15 upgrade path. You now qualify for SkyTab and kind of click here and we transfer your database over. It just has to be done in the most automated way possible. So it's not a lot of manual programming. So we have only by policy been doing SkyTab upgrades to the existing base for retention purposes, which represents like a very small, very, very small percentage of production every single month. The reality is we do have, tens of thousands of existing customers on our other products that we will migrate over the next couple of years. It'll just be done like thoughtfully over a couple of years through a relatively automated path.
Yeah, makes sense. Appreciate you taking the questions, Jared.
Yeah.
Our final question is from Andrew Schmidt with Citi. Please proceed.
Hey, Jared and team. Thanks for taking my questions. I was wondering if we just level set on the restaurant business for a minute. Maybe talk about just, where you're positioned. Obviously, there's a lot of variation in terms of assets out there. But, QSR versus table service, post-Revel, where you guys are positioned on a go-forward basis. Thanks a lot.
Yeah, it's a good question. I mean, we've always, said for some time that people, I think, they actually think the restaurant TAM might be a little bit bigger, when in reality there's three very distinct swim lanes in it, and they have their own kind of competitive set. So, competitive landscape associated with it. So in terms of your cash and carry, that's your coffee shops, your bakeries and such. That is Clover and Square. And essentially that is it. Then you have your fast food, which is Par, Xenial. Revel did play in that lane a little bit, and then you have table service, and that is really just Toast and Shift4. So I would say the Revel acquisition did give us some interesting capabilities where they have some retail functionality in it that we wouldn't have otherwise built. They have really solid fast food and enterprise capabilities. So we're just engineering that into SkyTab. So I mean, we already said the 15 million of EBITDA came from cost synergies. We're not building on that product anymore. There will never be another new feature that goes into Revel. We'll certainly upkeep it as we eventually migrate customers over to payments and SkyTab. But all our dev efforts have been steered towards SkyTab, including the Revel resources and talent that we've held on to. So we are building in those same type of Revel enterprise, quick service, and some retail capabilities into SkyTab right now. I think for the next year and change, you would continue to expect SkyTab to excel within the verticals that we focused on, which is table service. But I do expect a year from now, we are going to be able to move into some of those other lanes.
Got it. Thank you for that, Jared. And then maybe expand on the just the internal systems work. Does that, obviously there's an efficiency component, but there's also an offense component in terms of being able to develop faster, go to market faster. What does the internal systems work bring you in terms of tying everything together? Thanks a lot.
Oh, so much. I mean, I love this because so look, we're a 25-year-old company that started in my parents' basement. Our first CRM, which was largely in use up until a year ago, was homegrown. Like it started in Access and SQL. I mean, and bolted together through so many years. And then, of course, we have done a handful of acquisitions, and some of them have a homegrown system or CRM. And you find your employees, just from an efficiency perspective, are touching like eight different systems. It's not a great foundation to work on. It means you're carrying a lot of extra personnel to do all the things you need to do every day as fast as you possibly can. So we kicked off almost like 3 years ago. We call Project Phoenix. It's like a full rip and replace of all of our internal systems. It's built on Salesforce and Palantir, and it's going well. Like we constantly pump out new modules. Commercial team rolled out with it a long time ago. Now our new ticket system's all being generated from it. And I think it's important, and this is like the foundation for so much more. Now we can run AI solutions for like fast building POS menus. That saves efficiency, or that's time to install, like time to revenue for getting the systems out in the field, but also unlocks a lot of efficiencies. We're building our whole mission control system, so that's like our no-fail operations all over the world. So when you're having go lives in Europe at the same time as the U.S., it's monitored in a very like proceduralized environment, just like I've seen in other industries. So this is an important foundation we must have, and I think a lot of this goes to the eventual margin expansion that Nancy talks about all the time. Is like people probably don't appreciate how much personnel we have. We have 3,500 employees that upkeep a lot of old things, whether it's old POS products, old internal systems, gateway connections to our competitors, that as time goes on, we delete those parts and then can repurpose that talent to move even faster at new business. So it's like this way that we can keep headcount flat while accelerating growth and improving margins. It's pretty cool. Add on that.
I think you got it well. Thank you.
Cool. Appreciate that question. I'm pretty excited about those two projects. Well, look, hey, thanks everyone for dialing in. I know we'll catch up with some of the other analysts shortly on a next call. But yeah, thanks for dialing in, and take care.
Thank you. This will conclude today's conference. You may disconnect your lines at this time, and thank you for your participation.
Ladies and gentlemen, holy crap. The stock is moving up. They are content with Jared Isaacson's management. I like the ending there. I remember hearing something about Shift4 utilizing Palantir, but it was good to hear it again. And yeah, gotta love this company. Currently, stock's up 8.2%. Out of every stock that I follow, including some cryptocurrencies and everything, it's leading the charts. So that is fun. Gotta love it. We'll have to see if it actually sticks. All right. We don't know that for sure just yet, but I'll follow. I'll monitor it. Looks like, we're breaking 9% up, ladies and gentlemen. Can we break $70 a share? That would be fun. So one of the interesting things about Shift4 is just the idea of, how they are valued. So they even said, management, analysts are not giving us the respect that we think that we deserve. If we were just the quote unquote toast of the hotel and resorts industry, then we believe that we would be priced quite higher. The reason why they believe this is also the fact that they recently had acquisition targets. Okay, so people were looking at acquiring this company, and yet then analysts that today are saying this company should be worth $70, those exact same analysts came out and said, oh, well, if there's going to be an acquisition, we think it would be fairly priced at around $130 a share. Right? So this is why everyone gets a little bit, up and on their back foot because they think that that should be the price of the stock today. And yet later on they go, oh, well, no, thank you. We're going to lower the stock price. We don't know that restaurants is their forte and they might lose a large percentage of their overall volume, which Shift4 said was roughly about, 33% of their overall volume. Can we break 10% growth here in the early mornings? Brought to us by Moomoo. Will Moomoo give us 10%? 10% in the morning on good earnings. Yay! There we go, ladies and gentlemen. Can we hold it? That's going to be another story, but we broke through. Cool. Good news. Let me hear in the chat who all owns Shift4. Would you buy it after this earnings call? Is this something that excites you? A company that considers itself the SpaceX of the payments game. And by the way, the reason why he said SpaceX is that's also one of their customers. They do the payments for SpaceX as well. And not only that, the own CEO has been on SpaceX missions before, twice. So that is exciting. I just got some shares, Tanner. So today in the morning hours, Jerome Powell is building the position. Nice, nice. Which one are you selling right now? I want to know. I want to know. Overall, the size of this company, here, wait, let me check. Market cap of only $4.4 billion. Okay, $4.4 billion for Shift4 doing essentially what they said, $25 billion in backlogs. And the transfer over from Vectron and everything like this is going to lead to 10 years plus of just growth converting that single client over. However, it's going to take a little bit longer just because they don't have full control over that business yet. Maybe one day they'll buy the rest. Bought it on Black Monday and sold it just a few seconds ago. Okay, well, then you're the one that made this thing. I mean, probably not, but sold a few seconds ago. I like your conviction on the company, but I prefer to focus on SoFi and other stocks. I mean, this is the thing, right? Is like I find that this stock has less of a premium than SoFi and less of a premium than freaking like PayPal, and yet it's growing faster than all the companies that we talk about. In my opinion, this is like buying an Adyen at a PayPal level valuation. I actually don't know how it's this cheap at all. I think fairly valued, this company shouldn't be anywhere under like $100 a share. Overvalued at the moment. Sven, how could you even say that? Based on what? Based on what? It has a cheaper price to earnings, price to sales, free cash flow than PayPal does. And PayPal is not growing, or at least growing slowly. This company is growing at a 40% clip. And in an industry, yeah, it's unbelievably cheap. This is one of the cheapest fintechs I hold. I think Sven's worried about some certain European markets that they're entering, and that's fine. But the way that I look at it, it's all extra. It's not that they're not growing in the United States. It's that they're just expanding and growing elsewhere as well. Right? But we'll see how the day closes out. Very interesting stuff. Overall, great earnings. Some of the guidance stuff on revenue and everything could have done better, but Jared Isaacman is just playing the firefighter game right now. He's putting out all the fires that potential bears could be putting out on the stock, and it's great to hear. New $500 million buyback program. They've already used about 16 million of it in this quarter to buy back shares. And they've already said in the third quarter, so in July and August, they've already spent an additional 20 million. So from that perspective, there is a lot of buybacks to come. I like the way they framed it. They said the largest shareholder in this the largest shareholders in this company are the employees of this company. And that's actually, by the way, why I think that this stock is being held down, is because Wall Street has nothing to benefit from this company. So they don't value it because, Goldman doesn't have maybe a ton of equity in this company. So whenever you have a company that has not dealt with Wall Street at all, no Series A, B, or C's, just, no capital raises at all for the first 15 years of the business, you're essentially just growing organically, and Wall Street doesn't have to price you potentially higher because they have nothing to gain from it. And I think that there is a little bit of why buybacks now? Because it's a cheap stock, Sven. Because it's super cheap, because they have the money to do so. And by the way, they've been buying back stock for some time. They're just issuing more buybacks because they're growing at a faster rate than the stock is going up. They even said that a lot of the purchases from last quarter and a little bit before that was done in the $50+ ranges. So even then is doing much better than where the stock is today. Still up 7.5%, leading the charge on the entire watch list. Let's see what else is doing well. Solana, my largest crypto, also doing well. However, I'd like it much larger than where it is today. I want it back up to here. Not even. I want it back up to like even higher than that. Now, what else is doing well? Block up 3%. SoFi up 2.6%. Every time Snapchat goes up, I wonder why. I honestly wonder why. Shift4 up 7.8%, 7.6%. Pulling away from that up 10%. That's fine. No, you only buy back if you have too much money, like PayPal. What about Block? Hood's down now? Hood's down? Whatever. Whatever. Do you guys care? I don't care. That stock will go up eventually. It's just doing its own thing. Try to catch it later, but I put all my money in the Mag 7. I don't think that's a bad idea. I just got a thing for buying companies that are undervalued. That's all. Glad Hood is down, then I can buy more shares. Hey, you buying at 16? I won't buy at 16. If it drops down like 15.9, I'll start to buy again because I want to lower that. I want to lower that average. If you had to buy Hood or 4 after these earnings, which one are you buying? I mean, aside from the Black Monday event of just that small little dip, I have been acquiring Shift4 on a constant basis. I only have bought in Robinhood in really 2 separate occasions where it has dipped below the $16 mark, and that's when I ended up buying it. So, I mean, I would probably still say Shift4. Obviously, whenever one's down 1% and the other one's up 8%, it's hard to buy the one that's up 8%, but especially both of them having good earnings. But I mean, all else normalized, I would probably still be acquiring Shift4 because it's a smaller position in my portfolio and I want to grow it. But probably buying some SoFi as well because this is just ridiculous. Nubank down to $11.44. We'll have to see after earnings if this is worth it to be buying at this price. Like I said before, my fair value price for Nubank is somewhere around $16 a share. So, but it is my largest fintech. So I'm probably not going to be buying Nubank right now at the $11 ranges. And I can't just be buying fintech. So, yeah. All right, ladies and gentlemen, thank you all so much for watching. Really do appreciate your time. But that is all. Maybe I'll do more market opens. It's fun. It's just a matter of, if I can find the time and such. Should I cut 50 basis points next meeting, Jerome? I think you're gonna. If I can read your mind, I think you're going to. But ladies and gentlemen, thank you all so much for watching. Really do appreciate your time. Bye-bye for now.